Pooja, just mute yourself. Thank you. Okay, hello and good afternoon, everyone. Good evening. Thank you for logging into Marcellus's Consistent Compounders webinar. The subject of the webinar today is more about performance comparison on relative versus absolute returns basis, something that we thought is worth putting context to, because over the last 1 to 3 years, there have been several short-term different colors to the performance of CCP. So let me kick off by laying the context through this slide. So this is the consistent compounders PMS performance over different time horizons. What's quite interesting is that there's a lot of noise on this slide in the bars on the left. So whether it be 1 month, 6 months, 1 year, there isn't a clear direction. In some time periods, there is a healthy relative return. In some time periods, a weak relative returns. In most time periods, there's a weak absolute return over the last 1, 6 or 12 month periods. This is updated till 31st of August. If you include the month of September, there's a small outperformance of some 60-70 basis points. That's unaudited, and hence we haven't put it up here yet. But a very different messaging in the 2 sets of bars on the right. There's peace and tranquility. There's no noise, and you see absolute returns being healthy, and relative returns also being healthy and strong. What's also quite important is when you look at how the last 3 years have transpired, even on a 12-month basis, not just the last 12 months were noisy. Pretty much every 12-month period has been incredibly noisy. So if you look at say FY20, in FY20 there was a very strong relative return, but weak absolute return. So the relative return was a positive 33% alpha, but the absolute return was only a positive 8%, which wasn't even beating the let's say the risk-free rate or bare minimum inflation run rates for an investor. Whereas FY21 was exactly the reverse. In FY21, it was a weak relative return and a very healthy absolute return. So on a relative basis, we underperformed by 22% in FY21 because our fund's performance was 50% positive and the market's performance was 72% positive. But in absolute terms, a 50% positive is not at all a weak outcome. It's actually a very strong outcome. So it was a year, FY21 was a year of strong absolute and weak relative. So no matter how you slice and dice the historical performance into short time periods, there'll always be a lot of noise, which, as I said, the moment you look at say 3 years or 4 years or longer, there's peace and harmony, peace and tranquility in both absolute terms as well as relative terms, right? Now, there's something before I go into why this happens, why you should overlook some of the noise. There's an analogy from the world of cricket, which I thought puts things into context very nicely. So this is a worm chart. So for those of you who are fans of watching or playing cricket, this worm chart gets used quite often in the second innings of any match when the side chasing the score is batting. The worm chart is used to indicate where the progression of absolute runs of the chasing side stands in comparison to the runs scored over the same time period by the side batting first, right? And the worm chart progresses from start to finish, giving you that comparison. I think in many ways, this chart is a totally irrelevant chart, as in there's no logic to why this chart should give you any clear message, because when the team batting first was setting the score on the board, the objectives for that team were very different from what the objectives for the team chasing the score are, right? So to highlight, for instance, this chart is from the league match between India and Pakistan played about a month ago during the Asia Cup, which India won. And there's no partiality here. In the next slide, I'll show you the warm chart for the match where Pakistan won. So interestingly, a very similar message coming out there as well. Now, Pakistan put up a score on the board, which was around this 147, 148 runs. And India had to chase that target. Interestingly, during the first 17 overs of that match, India was underperforming on a relative basis. Whether you look at a 1 over, 3 over, 6 over, or 12 over basis, right? Very similar to an investor's 1 month, 3 month, 6 month, 12 month. India was underperforming versus Pakistan's score for the same time horizon, right? But the batsmen who were playing on the field during those first 17 overs probably didn't have the worm chart in their mind at all, right? Because it doesn't matter whether Pakistan had scored 10 runs extra or fewer compared to India at a particular point of time. What mattered to the batsmen playing on the chasing side was what is the required run rate basis the number of balls left and the number of runs to be scored and the number of wickets in hand. That, I think, was the objective. That always is the objective. I doubt if any batsman gets any satisfaction out of outperformance on the worm chart while chasing, because it doesn't matter. What matters is you have to get to a certain number of runs in certain number of overs without losing certain number of wickets, which has got nothing to do with outperformance or underperformance in the last 1, 3, 6 over time period vis-a-vis the side batting first, right? That's how irrelevant the relative chart here is, because the objective is something totally different. Now, this disconnect between the objective and what the relative return chart really gives you is something worth bearing in mind. I'll come to the investment analogy in a minute. And this is, as I promised, there'll be no partiality towards matches which India had won. This is the match that India lost, which was, I think, the sort of make or break for the tournament. And India was knocked out after this match. But interestingly, even in this match, when Pakistan was playing as a chasing side, in the first 15 overs, they consistently underperformed. Despite that, I doubt if any of the Pakistani batsmen had the worm chart in mind while chasing the total of 182. It was only the required run rate which they had in mind rather than the worm chart. Now, what is the sort of parallel worth understanding about the equity investment approach? So the parallel is the objective for an investor, really, right? When you invest in equities, is wealth compounding. Objective is not to beat your neighbor's equity returns over the last 3 months. That clearly doesn't make you wealthy in the long run if you beat your neighbor's returns. The objective is wealth compounding. Now, wealth compounding has to happen at a certain rate, which has to be a rate higher than what, let's say, your financial goals or lifestyle cost inflation or whatever financial requirements are. It has to be a rate which is high enough that meets all your financial goals. That's an absolute return objective. It is not a beat your neighbor relative return objective when it comes to equities, right? Which is very similar to sort of the irrelevance of the worm chart, but the direct relevance of the absolute target in the cricket field for a side chasing particular score, right? Now, associating this, linking this context first to, let's say, Berkshire Hathaway. Why Berkshire Hathaway? Well, not only because Berkshire is probably one of the most widely recognized, long-standing, high-quality investment manager, but also because there's a long enough history to understand about the relative versus absolute returns of, let's say, a fund like Berkshire Hathaway. Now, the interesting points here are the following. First of all, this chart, this colorful diagram that you see on the left, let me explain how to read it. So on the vertical axis, you see the years since Berkshire has been listed on S&P 500. And on the horizontal axis at the top, you see the months within each year. So 12 months in each year and around 34 years on the vertical axis in total, right? Across these 34 years and 12 months within each year, so roughly that would be sort of 400 months, give or take. Around, so across these 400 months, in 49% of monthly instances, Berkshire has underperformed the S&P 500, which is indicated by all the cells shaded in red. So the red shaded cells are the months in which Berkshire underperformed the S&P 500 by any margin. And the white shaded cells are the cells in which Berkshire outperformed the S&P 500, right? Which were only 51% of the instances. Now, that is a very different conclusion compared to the last 34 years or the last 50 or 60 years of 5 to 10% alpha, 5 to 10% outperformance that Berkshire has generated decade after decade after decade, and also throughout this 30, 40, 50-year time horizon, right? There hasn't probably been any 10 or 15-year period where Berkshire didn't outperform S&P 500 by a wide margin. Despite that, on a monthly basis, you see sort of 50-50 outcome, as in half of the number of months Berkshire has underperformed and half of the number of months Berkshire has outperformed, right? What is also very interesting is to note the series of sequential underperformance. And this actually links to one of the biggest mistakes that some investors might make when they look at relative returns. If you come across a series of long series of reds in succession on a monthly basis, it requires an incredible degree of clarity of thought on behalf of the investor to figure out whether that long series of reds is noise or whether it is a signal which needs an action from the investor, right? And that differentiation between noise versus signal, when you're faced with long series of reds, is probably the biggest challenge, the biggest area where due diligence on the fund's performance needs to be deep enough, thorough enough. Otherwise, wrong conclusions can be drawn. So when you look at, let's say, some of the encircled parts here, in fact, the encircled parts are more at the bottom half. Even if you look at, let's say, the year like 1996, right? In 1996, for 8 out of 12 months, you had underperformance of Berkshire versus S&P 500. When you look at, say, May 2004, somewhere here, till July 2005, in 12 out of 15 months, there was underperformance. Right? That's a very long period of consistent underperformance, month after month, right? 12 out of 15. Likewise, if you look at, say, March 2013 to June 2014, again, roughly 12 out of 15, or in fact, if you look at March 2013 to Feb 2014, 11 out of 12 months, there was underperformance, right? And that period is really the test of clarity of thought between noise versus signal, right? Some funds delivering consistent reds might be a signal that the fund manager has lost the ability to generate healthy absolute or relative returns, but some consistent sort of reds might not be a signal, it might just be noise, right? Now, interestingly, the moment you look at the same performance chart on an annual basis, so the previous one was monthly basis over 34 years. This chart at the top is annual basis over the same 34 years, right? And here you can actually see not the same. In fact, this is for a longer time period because annual performance data of Berkshire is available even prior to it being listed on S&P 500. So when you look at this whole sort of roughly 50, 60 years of data, you suddenly see it's a 70-30 split. 70% of the cells are white, 30% of the cells are red, unlike monthly data, which was 50-50 split. And if you were to reproduce this into, let's say, decadal periods, the 70-30 will go closer to 100-0, as in you'll see only whites, probably no reds, right? And average annual alpha, as you see noted here, is as high as 10%, pretty much double the return of S&P 500 over this time period, right? So that's how different even a 12-month chart versus a 1-month chart frequency looks like, right? And the moment you increase the 12 months to 36 months or to 60 months or to say 10 years, it's a very different message again. Now, the only thing which was not noisy, was the table at the bottom. Whether you look at 1 year, 2 year, 3 year, 5 year, or 10, 20, 30 years, the non-noisy part is the column on the extreme right. The compounding of Berkshire's book value per share was not as noisy as the share price CAGR. In the long run, it was only the compounding of fundamentals measured by book value per share in this case, which drove the share price at pretty much the same run rate, right? In the long run, nothing but the appropriate measure of fundamentals is what defines share price progression for any stock and hence for any portfolio of stocks, right? Now, that's about Berkshire Hathaway. In general, it's also worth understanding that when it comes to India, the relative return is far less meaningful than the importance of relative return when it comes to, let's say, countries like the USA or Germany or various other larger stock markets across the world. The difference is that in a country like, say, US, the index, it beats nominal GDP growth by a multiplier of 2, 3, 4 times, right? So for instance, in the last 10 years, index return in the US has been 3.6 times higher than nominal GDP growth in the US, right? In Germany, the same multiplier is sort of 3.7 times, so on and so forth, right? Not the same thing in India. In India, the index has barely beaten nominal GDP growth, no matter which time frame you take in the past, whichever long-term time frame you take in the past, the index does not beat nominal GDP growth by a healthy margin in India. Now, this is something which has a material implication for the importance of relative returns in India. If the benchmark that you are tracking, if the benchmark doesn't meet the absolute objective of compounding wealth, remember what's the objective of a stock investor? you have to compound wealth at a certain rate, right? If the benchmark is nowhere close to getting you that objective, then beating the benchmark at a fund level might not help you meet your investment objectives either, right? Because if you beat the benchmark by a narrow margin and the benchmark doesn't meet your investment objectives, doesn't come even close, then beating the benchmark might not help you meet your absolute return objectives of wealth compounding, which is actually slightly different from the way you can look at many of the stock markets outside of India, where there is still some relevance of looking at the benchmark. Right now, why does this exist? I think we've discussed in why does this dichotomy exist? We've discussed in some of the previous forums. But this is like, just to take an analogy, let's say if we are driving, let's say if somebody is driving in a car from Mumbai to Pune, you have two options as the road to choose from. One is you take the old Mumbai-Pune highway. The second option is you take the Mumbai-Pune expressway. Right? Now, if you are going on the old Mumbai-Pune highway, you are great at overtaking cars and you are driving in a relative way at the fastest rate on the old Mumbai-Pune highway. You might still not meet your objective of a comfortable ride and of reaching Pune on time. Whereas if you're driving on Mumbai-Pune expressway and you're not the fastest car, but you are probably the most consistent, peaceful, peace and harmony type of a car, driving at whatever, let's say 80, 90, 100 kilometers per hour rather than 120, you'll still meet your absolute return objectives of comfort and reaching your destination on time, right? That's actually the difference between, say, choosing a benchmark in India versus choosing a benchmark somewhere else, where in India, just because you are the fastest car vis-a-vis Nifty 50, or you are driving faster than most cars on Nifty 50, or most portfolios, most funds, doesn't necessarily mean you'll meet your absolute return objectives, right? So that's an analogy worth bearing in mind, the relevance of the benchmark itself when you compare your returns vis-a-vis the benchmark and have a relative return focus, right? Now, comparing all of this with what, let's say, a CCP has done, interestingly, very similar conclusions can be drawn about relative return of consistent compounders on a monthly basis versus the long term. So if you look at the monthly charts here, the monthly cells, which is the chart at the top, white cells outperformance, red cells underperformance. For 44% of the months, Marcellus' CCP has underperformed Nifty 50. And for 56% of the months, it has outperformed. Also, there are long series of reds, right? So starting with August 21, ending in June 22, you can see there were only 2 months of outperformance, right? And 9 months of underperformance. And starting in somewhere around Jan 19 till May 19 was a long row of 5 months of underperformance. Despite that, when you look at the chart at the bottom, the blue line is 3-year CAGR for various dates ending on the x-axis, as in the last date of the 3-year CAGR period is on the x-axis. Blue line is CCP, red line is Nifty 50. Both on an absolute basis as well as a relative basis, the blue line helps you meet your objectives, as in you're driving faster than the other cars on the road and you are reaching your destination with comfort and on time. The lowest 3-year CAGR of CCP has been 16% roughly, and the highest CAGR has been 30% on a 3-year basis. The average has been around 22-23%, right? That's the blue line at the top. Pretty peace and harmony over a 3-year period, but a lot of noise when you look at the monthly chart at the top, right? Now, this also has implications for instance, when you look at Rising Giants, for instance, another fund of ours, and look at the last 6 months, 8 months of performance, it's not too dissimilar vis-a-vis what CCP has delivered here, right? So just like CCP had 9 out of 11 months of underperformance between August 21 and June 22, pretty much the time period when we launched Rising Giants, we've had a very similar return there as well. But that doesn't necessarily mean that you draw conclusions about long-term compounding from those charts. So that's about CCP. This is a little bit of back test. This is a chart from Diamonds in the Dust, the book that we published last year. This is back test of the coffee can portfolios in that book, something that we had touched upon in Coffee Can Investing book, as well as Unusual Billionaires book. If you look at the performance of those coffee can portfolios, back tested over the last 20 odd years on a 1-year basis, right? The bars hanging down below the zero line are periods of underperformance. Reasonably frequent, right? On a 12-month basis, we've got underperformance in 2002, in 2005, 6, 7, underperformance in 2012, 2018, and long sequential time periods of underperformance on a 12-month basis as well, as in particularly the 2005, 6, 7 sort of 2.5 year, 3-year period, which didn't have a single 12-month rolling timestamp of outperformance. And at the same time, when you look at the absolute returns, there were a few periods of absolute return, the dotted line going down below zero. The moment you look at the same chart on a 3-year basis, it changes its look and feel. There was only one time period of significant underperformance, right? A smaller one here in 2016. But even during periods of underperformance, the absolute return was pretty healthy. And over a 3-year time period, you can see the low volatility in the absolute return outcome. The moment you extend this to 5-year and 7-year and 10-year, the time period of underperformance will go down to zero. There'll be only outperformance and healthy return on an absolute basis. So that's something from the back test, and hence just a quick conclusion about the investors need to have clarity of thought in order to distinguish between noise and signal. Signal is more fundamental. Noise is obviously worth ignoring. So I'll stop here. Pramod, do we have any questions that we can start answering?
Yeah. So I think, might be a repetitive question, but this is perhaps the most often asked question in terms of timing. I'll just read out a couple of questions which are related to that. One, so I want to deploy more funds, but I'm worried about the current volatility, not giving confidence to invest. Thought of waiting and watching what is going on. How do we resolve this? And there's another question around, I think the cause and effect, that's saying, if we know that there is a recession coming, will the markets bottom out, or will the markets bottom out till the recession actually affects the earnings? So I think we've tried to answer that in several webinars in the past. Rakshit, I'll leave it in your capable hands of addressing, because I thought those two queries are linked.
Sure. So look, the way to answer this question is actually nothing but by understanding what's happening to fundamentals and what is likely to happen to fundamentals. So if the global recession has a significant adverse implication for fundamentals of the underlying companies, then there's a very, very high probability that staying invested might be the wrong decision, or investing now might be the wrong decision. But on the contrary, if the fundamentals of the underlying companies are likely to compound at a very healthy rate over the next 2, 3, 4 years, then assuming that whatever is happening in the global macro context will lead to share prices giving a weak return over a 2, 3, 4 year period, or at least over a 6, 12-month period, is actually a wrong conclusion, because the underlying driver in cause and effect, the cause is fundamentals. It is not necessarily the macro noise. Again, just to highlight, before I go to the fundamental piece here, just to highlight from empirical evidence, in FY20, had you been sitting on cash rather than investing in these stocks, right? The macro was bad, index gave a negative return, and probably most stocks would have given a weak performance. But the CCP portfolio here in FY20, despite index giving -25, it generated +8. Somebody sitting on cash thinking that, look, I'll probably be better off investing after 12 months, actually had an adverse outcome. Now, obviously, you could argue that, well, I would have exited from CCP in January 2020 and re-entered at the bottommost level in April 2020. So don't tell me the 12-month return. Look at the 3-month period. There was an opportunity to go out and come back in. But I can guarantee you, had you done that, in 2021, when you saw that the Delta wave was far more severe than the first wave, the lockdowns were longer than the first set of lockdowns, the number of people dying, the negative news flow for business and human life was weaker. I'm sure you would have taken the same decision. You would have exited from the CCP portfolio or any other equity portfolio in March 2021 or April 2021, looking to re-enter once the wave settles down in June, July 2021. And that would have been massively negative or massively wrong decision, because most stocks, the market, and our fund as well, CCP, it went up during those 3-4 months of weak macro, right? So linking the macro to the economy to the stock market, and stock market to your concentrated portfolio of 15 stocks is actually not the right way to look at entry exit points. What makes a lot of sense, assuming you are not a trader, you are an investor and you are here for at least a couple of years or longer, what makes a lot of sense is to understand whether fundamentals of the underlying businesses are going to be adversely affected by the macro or whatever external events or not. And here, for instance, this is CCP's financial stocks' performance. These are for the non-financials, how the compounding over a 3-year, 4-year period has been incredibly healthy. Obviously, don't get flattered by a 205% year-on-year growth for Titan or a 59% for Asian Paints, because those numbers were flattered by the fact that June 2021 quarter, 1Q FY22, was a shut quarter for brick and mortar retail, particularly. Many products couldn't be sold on the streets. And hence you see some of these companies report a very healthy number on a YOY basis. But look at the 3-year CAGR, a 4-year CAGR, or let's say This is Asian Paints' volume CAGR over 4-year basis, quarter after quarter, right? A very healthy one. This is what has happened in the more recent past. On top of it, what you should watch out for is the outcome of this chart. Maybe you've seen this chart in our previous webinars. Without any concerns on the revenue growth or earnings growth in FY22, the free cash flow growth in FY22 has turned negative. Now, if your revenues have grown at, look here, if your revenues have grown at a healthy rate, if your profits have grown at a healthy rate, but your free cash flows have declined in a meaningful way, there's only one reason why that could have happened, which is investments have been accelerated. Now, if those investments have been accelerated in a way that doesn't give you conviction on acceleration in fundamentals in the years to come, then probably you should be worried. But if that gives you incredible conviction on what is coming your way in terms of fundamental growth in the years to come, then this is what you should be looking out for, rather than the quantum by which Fed hiked interest rate or Monetary Policy Committee in India hiked interest rates, or the quantum by which, let's say, GDP of a particular country moderated, so on and so forth. This is what you should watch out for. The increase in investments and the areas in which those investments were increased, which is pretty much around acquisitive activity, massive tech investments, and transitioning from traditional businesses to new age businesses. That's what we see. I'll not go into details, assuming that people asking this question have sort of heard us talk about the details of what sort of acquisitions, what are the benefits, what tech investments, what are the free cash flow acceleration benefits, and what sort of transformations from traditional to new age businesses that we can see in our portfolio. And that, as long as it leads to the rate at which free cash flows compound over the next 2, 3, 4 years, being a very healthy and an accelerated variant compared to history, I think you should actually be more excited about investing, regardless of the noise, the volatility in the short term, which in any case is like flipping the coin, tossing a coin.
Yeah, I mean, just to add to that, I think we've seen it in recent times itself, right? Rakshit talked about the COVID fall. I think 22nd March 2020 was when the lockdown was announced. If you knew then that there is this deadly disease out there for which we don't have a vaccine in sight, and the government has announced the lockdown for the next 6 months, which necessarily means consumption and production activity will be subdued, and hence it will also have an impact on the real earnings of companies, you would have thought this is the best time to take money out of the market. And it turns out that 23rd March, the very next day, was the bottom of the market. And then the next 6 to 12 months saw a massive rally. So while it's very tempting for us to believe that we can take these calls, I see a few other questions or saying that it is clearly evident that the market will fall in the next few months. I mean, if it's clearly evident, you should pull out all your money from the market. It's not just about not figuring out when to top up. You should exit the market. And it is not clearly evident to us, nor have we met anyone to whom it is clearly evident. Markets in the short run, like Rakshit keeps saying, is noise. Let's not pay more heed to this noise. Unfortunately, like I said, in hindsight, it might seem tempting, but in foresight, it's never really possible. We would all like to buy Asian Paints at 20% lower prices than this, right? Who wouldn't love to? I mean, we won't deny that, but it's just that we simply don't know, based on whatever scenario you paint. Credit Suisse is going down. There's another question there. There's another banking crisis. Who knows? There could be plenty of things that could happen out in the world there. None of these guarantee that the stocks that we would like to own will be available at lower prices. So therefore, given that inability of ours, you can say, I mean, like I said, we haven't known anyone who's capable, but let's assume that we are the only incapable people on as far as timing is concerned. We will live with that incapability by doing two things. One is taking a relatively longer term investment horizon, which is when we say investment horizon long term, we mean 3 years and beyond. And second is to believe in the companies that we invest in terms of their ability to grow free cash flows at a healthy rate over long periods of time. If you believe in these two, you've by and large negated the short-term noise effect. Then it's just a matter of holding your emotions tight and just bearing through the volatility. Beyond that, I don't think any of us can figure out how stock prices will react, even if we get the exact economic scenario right? Even if you got that the next 2 quarters will be a lockdown and therefore earnings of companies will be smashed, you would have got the stock prices wrong back in 2020. And we can go on with several examples of this. So with that, I'll just segue into the next question, Rakshit. So fair enough, we've seen this sort of an underperformance, or rather, let's forget about the relative performance. On an absolute basis, CCP hasn't done particularly well over the last 12 to 15 months. What does it mean for future returns? Right. So if an investor has come in 15 months ago and they've been patient enough with this, but they came in with a 3-year horizon, does that mean that in the next sort of whatever is left of it, 21 months, we'll be able to catch up to the long run steady state? If yes, what is the steady state return we should expect? Somebody's sort of put the finger on that number, saying, should we safely assume a doubling of returns in the next a doubling of returns in 4 years, in any period of 4 years? So I don't know about safely, but I think they're all wanting to know what's the sort of steady state long-term returns that one can expect.
Yeah, no, valid question, since it's been 15 months for many investors and they haven't seen wealth compounding through the portfolio. Just to put things into context, there are several instances of large cap stocks, right, which are supposedly well known, etc., going through a massive recovery in share prices after periods of wide disconnects between fundamentals and share prices, right? So this is one chart which can explain that. And actually, many of these share price movements, they lead to the overall portfolio as well, delivering a red shade for a long sequential time period on a monthly basis in those sort of colorful charts that we were showing. If you look at all of these instances, the first column is the time period for which these large companies have had pretty much no share price performance for 12, 15, 18 months. In all of these instances, the concerns have been around macro or competition, which is more external to the company than internal. And the fundamentals in all of these cases have kept surging ahead. The fundamentals did not show any sign of moderation in all of these examples. Because the fundamentals kept moving forward and the share prices were on sort of holiday, when the holiday period got over, the rate of compounding of these share prices was sort of 30% CAGR, 40% CAGR, 50% over the next 1 or 2 years. Why? Not because the fundamentals started accelerating in growth, but because the share prices had to catch up with fundamentals. Because in the longer run, the correlation between share price compounding and fundamental compounding is 1:1. So that's the sort of empirical context to start answering that question. Now, coming to the portfolio and the last 15 months, as I highlighted, particularly in terms of capital allocation, decisions taken over the last 1 or 2 years, and also specifically the last 15, 20 months of fundamental compounding, right? There is no moderation in either what has happened to fundamentals in the last 1 or 2 years, or what is likely to happen to fundamentals in the next 1 or 2 years basis the capital allocation decisions made in the last 1 or 2 years, right? So there's no moderation in fundamentals either in the recent past or in the expected near-term future. Near-term being sort of less than 3 years. But the share prices, clearly, you're right, in the last 15 months, haven't delivered anything at a portfolio level. That certainly calls for a catch-up with fundamentals over the longer term. Now, whether that catch-up is gradual and happens over a 5-year period, or whether it is sudden and happens within a 6-month, 12-month period, is anybody's guess. But yes, if you're patient enough when you ask the question about 4 years doubling, right, which is 4 years doubling is roughly 18% compounding, if I'm doing the maths right, the rule of 72, then certainly yes, the free cash flows of these companies are expected to compound at a rate much higher than 18%, and hence net of fees and expenses, the 4-year doubling is certainly the expectation here, particularly because in the last 15 months, there's been a disconnect, wide disconnect also created, right? So, so that's one way to look at it. But having said that, if you were to target it in that fashion and say that, look, by that means, let me expect mean reversion within the next 6 months, and wherever particular stock or a particular portfolio has had the weakest performance in the last 12 months means it will have the strongest performance in the next 6 to 12 months. So this mean reversion, where the mean is the fundamentals and you are reverting the share price performance to the mean reversion might not necessarily happen within a 3-month period. It might or it might not. But the moment you look at a 4-year, 5-year long time horizon, yes, that reversion to the mean, where the mean is fundamentals, will certainly be expected.
Thanks, Rakshit. So there are questions, I mean, a lot of questions around the insurance stocks in the portfolio, particularly HDFC Life and ICICI Lombard. Perhaps before we get into specifics of these two companies, in both these cases, the 3-year returns have been next to nothing, right? Literally zero returns for almost 3 years. Now, how does that sort of fit into our 3-year long-term philosophy when specific stocks could go for holidays for as long as 3 years?
Yeah, now, first of all, the interesting data point is that despite some of these stocks delivering next to nothing in 3 years, if you held the portfolio itself over a 3-year period, including these stocks, you would have still compounded at 20% plus, right? And the reason for that is 3 years ago, there were some other stocks which were ending their holiday period when an HDFC Life or an ICICI Lombard were starting their holiday period. Right? And that's something very important, very, very interesting, worth bearing in mind. So this chart is showing you where we were 3 years ago. If you can see my mouse cursor, this is where we were 3 years ago. A stock like Dr. Lal PathLabs was exiting the 3-year holiday period, when a stock like an ICICI Lombard or an HDFC Life was entering the 3-year holiday period, right? And over the last 3 years, Dr. Lal PathLabs, despite whatever volatility it has happened in the more recent past, it has compounded at a very healthy pace, more than offsetting the holiday period of, let's say, an HDFC Life or an ICICI Lombard in the same portfolio, which is nothing other than, putting it this way, that at any point of time, you will have at a stock level, maybe 20-30% of your portfolio allocations in CCP undergoing a holiday period. The only challenge is we can't predict which of that 20-30% of the entire exposure will be in holiday during a holiday period at any point of time. Otherwise, we would have obviously taken calls accordingly. We would have exited from Dr. Lal in 2017, beginning when we started managing funds, we would have entered into Dr. Lal only in 2019, so on and so forth. Likewise, we would have exited from HDFC Life 2 or 3 years ago, or ICICI Lombard, and entered just before their holiday period ends, etc. It's difficult to predict when and for which stocks these time periods start and end. But at any point of time, you should expect 1, 2 stocks or 3 stocks to be undergoing a disconnect vis-a-vis their fundamentals when it comes to share prices. And hence, at a portfolio level, we haven't had a 3-4 year holiday where the portfolio has delivered zero. In probably a worst case scenario where the world really does start coming to an end, you might have that, but in most scenarios that won't happen. But at the same time, over a 3-year period, you'll have some stocks within the portfolio that are on holiday. Now, particularly talking about HDFC Life and ICICI Lombard, their profit compounding over the last 3 years, right, has not been a weak one. And this is not for the first time that a financials company is undergoing this sort of a phase. We look at HDFC Bank, right? This is during the early noughties, a 3-year long period where profit compounding for HDFC Bank was as high as 48% annualized. Now, ICICI Lombard and HDFC Life has nowhere compounded at that rate over the last 3 years. It's been more like a 20-25% for those two companies as profits. But an HDFC Bank had a 48% CAGR in profits over FY00 to FY03, when the share price delivered a -3% CAGR over the same time period. But that was more than offset by the rally and the rate at which share prices then caught up with fundamentals in the subsequent 3-4 year period, where share price compounding was around 10-15 percentage points higher than the fundamental compounding. In the case of an ICICI Lombard and HDFC Life, fundamentals have compounded at a healthy rate. The main strengths of these businesses are not only intact, further strengthened. So to begin with, if I talk about HDFC Life, the ability to innovate on the product side when you launch new products, then marry that with high quality processes and systems to get the spread of distribution and the spread of that product portfolio in the overall balance sheet in a very diversified manner and a very relevant manner, where you're not just selling ULIPs, you're not just selling one product at a time. In fact, you're selling a basket. And the discipline around putting in assumptions for embedded value, and hence what you see is what you get, rather than sort of the mortality or the persistency or the interest rate assumptions undergoing changes over a period of time for a life insurer like this, indicative of a life insurer not knowing what they're doing when they underwrite risk while issuing policies. That discipline, the product portfolio, and the system and process approach towards distribution, and more recently tech orientation as well, is where HDFC Life has always been the strongest. ICICI Lombard, probably the most disciplined, or probably the only disciplined non-life insurer, where you've got a combination of reasonable growth, but in addition to that, a very strong focus on underwriting profits or underwriting quality, and hence ensuring that your combined ratios aren't 120%, 130%, they're closer to 100 or below 100 at times, moving away from some lines of business which don't make sense, deploying capital to carry out acquisitions such as, say, the Bharti AXA acquisition, which adds muscle to your distribution capabilities. Those are some of the strengths that an ICICI Lombard possesses as a business, which have been the reason why we continue to expect for both of these companies a very healthy rate of compounding of top line and bottom line over the next say 2, 3, 4 years. So again, when will the holiday period end? Maybe today, maybe next month, maybe after 6 months. But certainly, the rate of compounding of the fundamentals is the guide to what the share price is likely to deliver over the longer run.
Okay, there's one question perhaps related to our rebalancing strategy. There's a client who's asking, he's an SIP investor, he's an SIP going. Does the SIP funds sort of get to benefit from our rebalancing approach, i.e., do the SIP funds go towards buying more of those stocks which have fallen, and hence the need to rebalance by selling something is reduced? Is that the way we actually implement it, is the question.
Well, yes, at all points of time, all investors, whether they are the standard investors, standard as in lump sum investors, or whether they are SIP or STP, the equity part of the portfolio at any point of time gets treated in the same way for all investors. Now, first of all, to quantify the benefit, that I guess is the reason why the person asking this question is putting this point up. The benefit of the rebalancing that we carry out is more than 200 basis points on an annualized basis over the last 4 years, if you were to quantify it, right? That benefit is on the entire equity portfolio of a particular client, without waiting for the next top up, which could be lump sum, or the next top up, which could be an SIP investment. At any point of time, if the portfolio has undergone dislocation, right, whether it be May 2022, Dr. Lal Path Labs, June 22, Titan, last month, Divi's, 3 years ago, Bajaj Finance, 4 years ago, Page Industries, last year, it was Asian Paints when the Grasim scare came up, etc., right? No matter which rebalance event you're talking about, on the date when the dislocation becomes sizable enough to benefit from, whatever funds have been deployed in the equity portfolio will be rebalanced. In future, if the top up comes in via an SIP, then the top up might actually go for a deployment in a fashion which rebalances the portfolio further, but that might be a little marginal rebalance. The sizable rebalance, in order to benefit from the dislocation, doesn't wait for the next SIP inflow when we do the rebalancing for the client, right? So all clients treated on parity, regardless of whether we expect an SIP inflow or an STP inflow at a periodicity in future.
So just to confirm, the same thing for non-SIP top-up as well, right? So that will be counted as cash in the portfolio and allocated accordingly.
Yes. So non-SIP top-up, when it comes, because we can't predict it, whenever it comes, on that day, it is used to rebalance the portfolio if the portfolio is out of sync slightly from the rest of the model portfolio. Had the portfolio been meaningfully out of sync, then even without waiting for the top up, even without using the top up, we would have carried out the rebalancing activity for that client. If it is only marginally out of sync, then the top up that you make, it is used to rebalance the portfolio to benefit from that marginal piece. Now, if there was no top up, we don't do marginal rebalancing, as in if there's only a slight 0.5% rebalance in the allocation needed, we won't do that 0.5% because one, there are transaction costs involved in non-top-up rebalancing. Two, there is an element of exposure to uncertainty during the T+2 time period, the time period between triggering the sell transaction and getting the cash to repurchase something else. During that time period, we are a little handicapped on that piece because we don't have the cash to buy the next stock, and the share prices are still moving every day. So for a marginal dislocation, we don't do rebalance. If there is a top up, we do rebalance even for that marginal dislocation. But for a meaningful dislocation, we don't wait for the top up. We do the rebalance regardless.
So it's not just the sort of capital gain that you save with the top up and SIP, you will benefit from a more frequent rebalancing as well.
Correct. That's right.
Okay. So there's one follow-up question on insurance policies. Historically, insurance companies have been sort of accused of mis-selling, particularly ULIPs. I think the gentleman who's asked the question is talking about the times that we all know during the noughties. And hence, there is a shift towards more traditional products such as term insurance. The question is, are term insurance policies better for the insurance companies from a shareholder's perspective, from a profit perspective, as opposed to the ULIPs that they were used to sell?
They're better. It's a very interesting question. I mean, there's no one-line answer for all companies. Term insurance is far more difficult to underwrite than, say, a ULIP or something where long-tail risk is not being underwritten. And the main reason for that is you're writing a long-tail risk without probably at times knowing the appropriate pricing of that risk, right? Now, just to give you an example, when it comes to annuity products, India hasn't had a long enough history of selling annuity products that gives an insurance company enough data points to use for appropriately figuring out the pricing of that risk, right? Because you need some data set that tells you about various elements of risks, the way they have played out in the past, the way the demographic undergoes those risks on an ongoing basis. Most insurance companies, they don't have this data point, these data points available. As a result, on the one hand, it becomes very difficult to underwrite at the appropriate pricing long tail risks such as term and annuities. At the same time, it becomes a massive opportunity for a high quality insurance company to create differentiation vis-a-vis competition, right? And that opportunity is where particularly somebody like HDFC Life, ICICI Lombard doesn't do long tail risks. HDFC Life particularly on the term and annuity side has far better processes, far better capabilities to underwrite at appropriate prices rather than getting into price wars in order to write the premiums on which in future you incur more losses than profits. And hence use your balance sheet more judiciously than your competition. That actually becomes an opportunity. Remember, every difficult environment is an opportunity for a great company. Anybody can write ULIPs. There's no differentiation that an HDFC Life can create out of writing ULIPs. It's by trying to underwrite term plans and annuity plans and a wider basket of products at more appropriate prices to the right type of customer is what actually underwriting differentiation is that an HDFC Life benefits from.
Okay, I guess we have time for one last question. It's an interesting question. The question goes, does the Marcellus team carry out deeper, more detailed forensic, more detailed analysis on competitive advantage, more detailed analysis on capital allocation when stocks go on an extended holiday period?
Yeah, I mean, honestly speaking, let me put it like this. There are three types of processes that exist at Marcellus around capital allocation analysis. of an investee company after we have done the investment. One is a periodic ongoing update on the lethargy score, if you're aware of our research process terminology. The lethargy score, just to highlight, measures prudence in recent capital allocation decisions that gives conviction around ability of the company to do more of the same in its core business in a better way, progressively. Secondly, ability of the company to add new revenue growth drivers in deeply moated areas beyond the core. And thirdly, ability of the company to radically change its business model, which can be termed as disruption, in order to avoid a competitor from catching up and in order to actually drive faster disruption of the competitive dynamics in the overall industry. So those are the three areas: doing more of the same, adding new revenue growth drivers, and radical disruption. One is the periodic update that the research analysts at Marcellus, they undergo while understanding the evolution of a business. That periodicity is linked to new data points coming through ongoing regular primary data checks or publication of a new annual report or a quarterly results announcement, so on and so forth. The second is something that we call internally as a sort of challenger construct, where even if nothing has created a panic around the stock, there is an incentive for Marcellus's analysts to push their colleagues by launching a challenge on some of the existing stocks. And this challenge is to sort of keep a check on biases creeping in, our own sort of lethargy creeping in, whilst trying to stay up to date with the evolution of the company's capital allocation decisions. So those are the first two. The third one, which is a lot relevant to your question: if the stock goes on holiday period, there must be some noise around it. Either a noise of, well, ICICI Lombard seems to be losing market share, or Dr. Lal Pathlabs is facing competition from Tata 1mg and PharmEasy, or Asian Paints is going to face entry of Grasim with a 10,000 crore capex, or a Page Industries has got a Van Heusen as new competitor 2019 coming in and offering aggressive dealer discounts, so on and so forth, or a Bajaj Finance undergoing a share price stress due to COVID related concerns around the unsecured book of Bajaj, etc. Right? So those and many more are the concerns which sort of kick off a holiday period in most cases. And whenever this happens, before we press the button on rebalancing in order to benefit from the opportunity, the dislocation of buying more of the stock under holiday and selling more of the stock which is running ahead of fundamentals to make space for the rebalance purchase, before we do that, there's a lot of acceleration in the ground level primary data checks that we do to ensure that we are not missing out on the recent developments which have caused a concern in the broader markets' perception of share price trajectory of that particular stock, right? And that's very important, because we can't just assume that if we've bought something in our portfolio and the share price isn't performing, then nothing to be worried about until the next quarter's fundamentals are reported, right? We can't do that. So we go on an overdrive to check the recent developments, whether we should be concerned or not. And that's typically around capital allocation decisions and how they're having an impact at the ground level for this particular company vis-a-vis competition or macro. So yeah, you're right. When the holiday period starts, actually, there is an even greater incentive to stay on top of things than otherwise, because not only do we have to take a call on staying invested, we also have to take a call on using it as an opportunity to rebalance the portfolio.
Great. Thank you. Thanks, Rakshit. And thanks, everyone. It's been yet another interesting session, and hope to see you all again for the next webinar. Thank you.
Thanks, Pramod. Thanks, everyone.